So when you say it's just started out in 2014, how much did the UAP investments have under management?
Much at the start of 2014, I would say zero, because we hadn't received our licenses and all that stuff. So
it was a real startup.
It was a real startup. Yeah. I mean, they had a few staff here, but you know, as a startup, there was some staff that were leaving. Like the portfolio manager was going to Wharton to do his MBA.
Yes.
So he was in transition. So it was a lot of flux. So when I came in, there was a lot to do.
And then how did you decide to tackle the investment market? Well, you know, what is the investment market out there, and how have you built up your business?
I mean, for us, you know, one of the things about investments is it's a trust game as well. And in addition to that, you know, we didn't have staff, so I had to build up the staff.
Yes.
But then when you build up the staff, you have to make sure that you have the systems, the policies, the procedures in place to make sure that, you know, it's a well-run organization, and, you know, everything is, you know, good corporate governance and all that. So that was my first task, because even before getting the money in, because you can't really manage the money if you have nobody to manage it. Yeah. So it was building up the staff and making sure that we have a, you know, a good enough staff complement to operate at the level we're at in terms of the funds we have. So that was my first task, and, you know, putting the systems in place, which I did. And then after that, you know, it was time to start getting money in to manage. So usually, I mean, we have the insurance and life business, which are related parties. So those were the first mandates we got. And though, in total, we have about 12.5 billion
under the investments group.
Under the investments, exactly.
And that's a meaningful amount of money.
It is. I mean, especially in a period of 6 months. Some of it is internal, but it's good. We had to, you know, do the pitches to them. We had to do proposals for them. So it was good.
And how do you segment your funds? I mean, how are you managing this? You know, these funds. What I can see that about 4 products. Is that right?
So we have unit trusts. I mean, that's just the normal ones. We have the money market fund, the high yield bond fund. The difference between the two is just duration. You know, the money market is more short term. High yield bond fund is more long term. But they're both invested in government securities and securities that protect you, give you principal protection. Then we have an enhanced income fund, which is a 50-50 split between bonds and equities. So you're taking on a bit more risk, but you still have a bit more protection on the 50% that's invested in bonds. Then we have an equity fund that's 100% equities. So that's for the, you know, the more risk averse. I mean, people who are less risk averse and who want to take a risk on the market.
And over the last 12 months, how have they performed?
I mean, we've beaten the benchmarks for all the funds that we have. The unit trusts all beat their benchmarks. When it comes to the money market, right now we kind of we have one of the higher yielding money market funds. So if you take a look at the paper and the dailies, you'll see the UAP money market fund. We're consistently among either 1 or 2 in terms of our yield.
And what is and then what is the strategy? I mean, what is your philosophy of investment? I mean, obviously, you know, the nature of these businesses, it's your philosophy that sort of.
I mean, are you talking about my personal philosophy?
Your personal, and then UAP, and then how? What?
I mean, I think UAP investments, what we try and do here is we're value investors. So we look at the fundamental, you know, when it's bottom up and top down as well. So you start, you look at the macroeconomy, then you see, okay, you know, GDP is going to grow by this much. Okay, if GDP grows by that much, which industries are the ones that are going to contribute most to that GDP? Once you figure that out, then you drill down to which companies within those industries are going to do really well. Then you filter out between those companies and then find the company, you know, that's got the most value in terms of, is it underpriced? Does it have good management? You know, what are their prospects? What are the plans for the future and things like that? So when you look at a company, you take a holistic view. You don't just look at their earnings. You look at every single aspect of it. So that's what we try and do here.
Okay. And you know, do you take big bets, for example?
I mean, investing is I don't want to say it's a risky game, but, you know, in order to make money, you need to take some risk. And the risks we do take, I mean, we're not, when you say we take concentrated bets, so if we think, for example, a company is going to do very well, then we will make a concentrated bet on that company, so that, you know, because the Kenyan market, if there's 20 stocks and if there's 60 counters in the Kenyan market, only I'd say 10 to 15 of those are quote-unquote quality companies, which means everybody else is invested in them. So for you to make a difference for your clients, you have to make, you know, either a concentrated bet or a more, you know, you have to pick something out of those 15 stocks to make a difference. Otherwise everybody is doing the same thing. So, you know, if I own Safaricom, that guy owns Safaricom. The other managers own Safaricom. So how am I any different? So do I own more Safaricom? Am I overweight on it? Or am I underweight on it? So those are the things you have to do to differentiate yourself and to get a better return. Yeah.
At UAP, we enhance lives across Africa to deliver the dreams we all hold so dear. Insurance, investment management, property investment, and financial advisory. UAP, better, simple life.